John Higgins, Mortgage One. Happy Monday. So we're back to another Fed week. We've got the Federal Reserve meeting this week. It is expected. Market has it at 99% that the Fed will cut an additional 25 basis points on the Fed funds rate. But we've seen this play out the last couple meetings where the Fed has cut rates as expected, and the market really has not seen any bounce off that. In fact, if you go back to the 50 basis point cut a couple meetings ago, we had bottomed out on interest rates over maybe a 2-year period, down around 361 on the 10-year Treasury, which put our mortgage interest rates on 30-year fixed money, in a pretty nice position, heading closer to 6%. Since then, we've seen nothing but a rise in rates. And why is that? The Fed has a dual mandate. One is they're trying to keep inflation down, and that has been incredibly sticky. We've got another reading after the Fed meeting on their favorite gauge of inflation, the PCE. We'll see where that comes in. That'll give us some indication of what's going to happen into 2025 with rate cuts. But, inflation has not really been able to make its way from, the very elevated numbers that we saw. I think it peaked out around 8 or 9%, to that 2% number that the Fed wants to get to. We're stuck somewhere closer to 3%, depending on which gauge you look at, and it's not making much progress lately. And that's been the number one reason our mortgage interest rates just refuse to go down much. So we'll see what the Fed has to say, and then, of course, later in the week with the inflation numbers. But right now, we expect that 25 basis point cut with maybe some tempered language from the Fed that maybe this could be the last rate cut for a bit until they see some improvement on inflation. So we'll see what transpires on Wednesday with that and give you an update next week. Talk to you then.